Greetings to all our listeners of the Stock Explorers community.
Hello, everyone.
Today we're diving deep into a company that's certainly been making waves, TSS Inc., ticker TSSI.
That's right.
For anyone looking at potential investments, this analysis is really designed to, cut through the noise, give you a clear picture of what's driving this company and, well, the key things to think about.
Exactly. And TSS Inc. has shown some truly remarkable recent performance. We're talking explosive revenue growth.
Yeah.
So our goal here is to really dissect those numbers, figure out what's behind them, and critically look at whether this kind of rapid growth can actually last.
And what investors need to keep in mind.
Absolutely. The crucial considerations.
Okay, let's get straight to it then, this phenomenal growth.
Yeah.
Q1 2025 was, well, pretty extraordinary, wasn't it?
It really was. Their revenue just ballooned, up 523% compared to the same time last year, hit $99 million.
Wow. And just to put that in perspective, Q1 2024 was what, under $16 million?
Just under $16 million, yeah. So, like you said, not just growth, it's an explosion.
Right. And it wasn't just the top line, was it? Net income saw a huge jump, too.
Huge jump from basically $15,000 profit to $3 million.
$15,000 to $3 million.
Yeah. And earnings per share went from nothing, really, $0 up to $0.12.
So understandably, the market reacted pretty positively.
Oh, yeah. Stock price jumped almost 42%. The market definitely took notice.
Okay, so digging into that growth, where exactly is it coming from? It's not spread evenly, right?
Not at all. The procurement segment was absolutely the engine here. An incredible 676% increase. Hit $90.2 million.
$90 million just from procurement.
Just from procurement. It's now, what, over 91% of their total revenue?
And just to clarify, procurement is essentially them acting as a specialized sourcer.
Yeah.
Buying and supplying hardware, software.
Exactly. They find and provide what their clients need. And this huge surge is directly tied to the massive demand for AI infrastructure, all the hardware needed to power artificial intelligence.
Thanks.
And get this, their procurement revenue in just Q1 was already 77% of their entire procurement revenue for all of fiscal 2024.
77% of the whole previous year in just one quarter. That really paints a picture.
It really does. Shows the scale.
But it wasn't only procurement, right? Systems integration also saw some solid growth.
That's right, yeah. Systems integration, that's more about the services like assembling and configuring complex AI racks, the specialized computer systems for AI.
Putting it all together.
Exactly. That segment grew 253%, reaching $7.5 million. And management sees this as just the beginning, really. They think it's the early stages of a long growth cycle, driven by that need for more AI processing power.
So that's a key area they're focusing on for the future, potentially higher margin too.
Potentially, yes. It's about having both capabilities, sourcing the parts and expertly assembling them, especially for these demanding AI setups. That could be a real advantage.
Okay, so sourcing and assembly, both booming thanks to AI. But there was one part of the business going the other way?
Yes. The facilities management segment, this includes their modular data centers, it actually saw a 40% decline in revenue down to $1.3 million.
Okay, so that's quite a contrast.
It is. Historically, it was a more stable, predictable revenue stream. Now, it's obviously a much smaller piece of the pie.
But management isn't giving up on it.
No, they seem optimistic. They're talking about potential in high-density computing, edge AI environments, places where adaptable data centers might be needed. They're hopeful new deals could turn it around.
All right, so explosive growth tied to AI, one segment contracting. Now, the crucial bit, profitability. Because massive revenue growth doesn't always mean massive profits, right? Costs can balloon too.
That's always the critical question. And here, while their gross profit did jump significantly up, about 239%, it didn't keep pace with that 500+% revenue surge.
Okay, so the margin percentage went down.
Exactly. Their overall gross margin fell from 17.1% in Q1 24 down to 9.3% in Q1 25.
And that margin squeeze, it's really down to that procurement segment dominating, isn't it? Which naturally have thinner margins.
Precisely. Procurement just operates on lower gross margins compared to services like systems integration. So they're selling way more stuff, but the profit margin on that stuff is, on average, smaller, pulling down the overall average percentage.
Right. Higher volume, lower margin per item affects the overall mix. But I thought there was something about the margins within procurement maybe improving.
Ah, yes, good point. So on a standard GAAP accounting basis, the procurement gross margin stayed pretty steady, around 7.8%.
Okay.
But on a non-GAAP basis, which adjusts for certain items, looks at the total transaction value, gives a slightly different view, those non-GAAP procurement margins actually improved a bit from 4.6% to 6.6%.
Interesting. So that might suggest they're actually getting more efficient or maybe getting better pricing within their procurement deals, even if the overall margin percentage is down because of the mix.
That's a reasonable interpretation, yes. It suggests some underlying efficiency gains, even as the sheer volume pulls the average down.
That's a helpful distinction. So
Yeah.
overall percentage down, but maybe doing better within that segment. What about further down the income statement? Operating income, EBITDA.
Now this is where the story gets really compelling, actually. Despite that gross margin pressure, TSS showed really strong operational leverage.
Meaning their costs didn't rise as fast as sales.
Exactly. Their operating income shot up over 1,500%. 1,500%. And adjusted EBITDA increased tenfold.
Wow. Okay, how?
Basically, their operating expenses, like SG&A selling, general, and administrative costs, they grew, sure, but much, much slower than the revenue and gross profit grew.
So they managed their overhead really well.
Incredibly well relative to the sales explosion. So even with lower average gross margins per sale, that efficiency meant more of that gross profit actually dropped to the bottom line.
Okay, that's definitely a positive sign. Managing costs effectively during hypergrowth. Now, the big question for investors, sustainability. Is this a one-off spike driven by the current AI frenzy, or is there a longer runway here?
Right. To gauge that, you have to look at the bigger picture. TSS's growth is, it's undeniably tied to this global AI infrastructure boom.
Which doesn't seem to be slowing down.
Not according to forecasts. Global IT spending is projected to keep rising, and a big chunk of that is specifically for these AI-optimized servers. The CEO himself said they believe we're still in the early innings of this whole AI build-out.
Implying there's a lot more demand to come.
That's the implication, yes. Plus, the related high-performance computing market, HPC, that's also projected to see healthy growth for years. So the tide they're riding seems pretty strong.
Okay, so the market dynamics look favorable. But just being in the right market isn't enough. TSS has also made some big moves themselves, right? That new facility.
Absolutely crucial. Their new facility down in Georgetown, Texas, it's a game changer for them.
How so? Bigger?
Much bigger than what they had. But the really critical part is the power capacity. Significantly more power.
Which you need for testing these complex AI systems.
Exactly. These AI racks are incredibly power hungry. You need serious juice to test and configure them properly. This facility gives them that capability. It just started operations in May, expected to be fully ramped by June.
That's a major investment, though.
Oh, yeah. Around $25 to $30 million total investment. But here's the interesting part. Management is targeting a payback period of about 2 years.
2 years? That's pretty quick for that kind of outlay. Shows confidence.
It absolutely does. It suggests they're very confident in the demand for the high-value integration services this facility enables. It really gives them potentially a competitive edge for these complex AI jobs.
And it's not just the building, it's also relationships, right? Customers, partners.
Correct. They have a multi-year deal with their largest customer, which helps with predictability. And they stress their position as a trusted partner for the big names in data center tech. Those relationships are vital in this space.
Okay, strong market, new capable facility, key relationships. Looking ahead then, what should investors be watching? What are the key milestones or indicators?
Several things to keep a close eye on. First, how quickly can they ramp up production volume at Georgetown? Can they really use that new capacity effectively? That's number one.
Makes sense. What else?
Second, watch the mix, the revenue balance between procurement and systems integration. Ideally, you'd want to see systems integration, the higher margin part, becoming a bigger piece of the pie over time.
Right, for better overall profitability.
Exactly. Third, track those margins gross and operating. Management expects them to improve as that mix shifts. We need to see if that actually happens.
Okay, facility ramp, revenue mix, margins, anything else?
Yeah, watch for any news on significant new customers, especially for AI integration work. And maybe keep an eye on that facilities management segment. Any signs of life there would be a bonus, I suppose.
And longer term, the big strategic goal seems to be shifting more towards those higher margin services, using Georgetown as the enabler.
That's the plan, yes. Procurement drives the headline revenue now, but it's more volatile, lower margin. The strategic play is definitely leveraging Georgetown to grow systems integration and improve overall profitability. hitting that 2-year payback target on the facility would be a huge validation of that strategy.
Okay, let's switch gears slightly to financial health. We mentioned positive operating cash flow in Q1, which sounds good.
Yeah, $20.6 million in operating cash flow is definitely strong. Shows the core business is generating cash right now.
But what about the balance sheet overall? Liquidity,
Yeah,
debt.
right. Looking at the balance sheet at the end of March, the liquidity picture is, well, a bit tighter. Their current ratio, current assets versus current liabilities, was about 0.85.
Below 1.0, which can sometimes signal potential short-term pressure.
It can, yeah. It suggests they don't have a huge cushion of liquid assets over their immediate obligations. We also saw big increases in inventory and accounts payable.
Which reflects the ramp-up in business.
Exactly, especially in procurement. Looks like they're scaling up operations and using supplier credit pretty heavily, which is common, but something to watch.
And what about debt levels? That Georgetown facility wasn't free.
No, definitely not. They do have significant leverage. Total liabilities are quite a bit higher than stockholders' equity. There's long-term debt on the books, plus substantial lease obligations likely tied to the facilities.
And that means higher interest payments.
Yep. Interest expense went up noticeably in Q1. It's a cost of financing that growth and investment.
So generating cash operationally, which is good, but also carrying significant debt and lease obligations and facing ongoing investment needs. Does this mean they might need to raise more money soon?
That's a very real possibility. That Georgetown investment is a big capital outlay. Management themselves have acknowledged they might need more funding, could be debt, could be issuing more stock.
Have they prepared for that?
They filed what's called an S3 shelf registration back in January. That basically gives them flexibility to offer securities relatively quickly in the future if they decide they need to.
So the positive cash flow helps for now, maybe eases immediate pressure.
It probably does, temporarily. But to sustain this kind of growth trajectory and keep investing, it seems quite likely they'll need further financing down the road.
Okay, so a lot to unpack there. High growth, exciting market, but also financial considerations. Let's try and summarize the key takeaways for potential investors. The positives first.
Sure. Positives. Strong market demand in AI and HPC, that's a huge tailwind. The new Georgetown facility gives them serious capability and a potential edge. They have key customer relationships and partnerships with OEMs. They've shown they can leverage operating costs effectively. And they're an early mover in this whole AI infrastructure build-out.
Lots to like there. What about the negatives or risks?
Okay, on the flip side. Current gross margin pressure because of that revenue mix that needs watching. Reliance on a few big customers creates concentration risk. That facilities management segment is still declining. There are always challenges with scaling up operations this fast.
And the financials.
And the financials, yeah. High financial leverage, relatively tight liquidity right now. Plus, you always have broader risks, macroeconomic stuff, geopolitics, potential tariffs, and competition OEMs, other integrators.
Okay, so bringing it all together, what's the core narrative here for someone looking at TSSI?
I think you see a company in hyper-growth mode right in the thick of the AI revolution. The huge challenge and the huge opportunity is making that transition, shifting the business mix from being dominated by lower margin procurement towards more of those higher margin services that the Georgetown facility enables.
So the focus should be on execution.
Absolutely. Investors really need to watch the Georgetown ramp up closely. See how it impacts the revenue mix. See if those margins start to improve as planned. The next, say, 12 to 18 months feel pretty critical. They'll tell us if TSS can really convert this incredible top-line growth into sustainable, profitable growth for the long haul.
A really fascinating situation. A lot riding on that execution and the continued AI boom. Thanks for breaking that all down for us.
My pleasure. Definitely want to watch.
And thank you to everyone in the Stock Explorers community for tuning into this deep dive. If you found this analysis helpful for your own thinking, please do give us a like and make sure you're subscribed for more deep dives into companies and market trends.
Yeah, hit that subscribe button.
And activate those notifications so you don't miss the next one. We look forward to exploring another stock with you soon.